Good afternoon and a warm welcome to all joining our webinar on Essence of Asset Allocation in today's market scenario. I'm Aakanksha Shukla, your host for the event. I'm heading Products Desk at Mastertrust. Thank you for joining us on StreetXperts today for an interactive afternoon with our expert speaker, where we will understand the concept of asset allocation. Why is this religiously followed during financial planning? And few most talked about asset allocation strategies. With that, let's start today's discussion. I would request active engagement. Please feel free to drop in your questions in the Q&A section, which will be taken up at the end. Thank you once again, and let's make today's webinar enriching for all. With that, I will quickly introduce our expert speaker for the day, Ms. Amrita Mohanty. Amrita is a seasoned professional in the financial sector, currently serving as a Chief Learning Officer at Sundaram Asset Management Company. Her career spans over 21 years in the BFSI sector, marked by significant contributions in learning and development. Before her current role, she led the Learning and Development Department at White Oak Capital Group and was the head of Franklin Templeton Academy. Amrita has a proven track record of designing and delivering impactful training programs. She has conducted numerous training programs across the country, conceptualized and devised workshops and sessions. She has also authored more than 200 articles aimed at demystifying financial market terminologies and jargon. Her expertise lies in the domain of mutual fund investment concepts, financial planning, behavioral economics, investment products, microeconomics, and product portfolio management services. I extend my warm welcome to you, Amrita, once again.
Thank you so much, Aakanksha, for the wonderful welcome. I really appreciate it.
So with that, team, we'll start our session. So just volatility is the heartbeat of financial markets, offering profit opportunities while also causing sleepless nights for investors. While some thrive on this adrenal rush of market fluctuations, others shy away, deterred by the potential losses. This is where one must stick to suggested asset allocation, which helps sailing through all the ups and downs of market that it has to offer towards reaching your goals. Our esteemed speaker today will dwell into why asset allocation itself is a strategy and how do we successfully navigate through this action-packed Indian markets with its help. So over to you, Amrita, without any further delay.
Sure. Thank you so much, Aakanksha. I'll just quickly share my screen and we'll take it forward from there. Sure. Aakanksha, is my screen visible to everyone?
Yes, it is, yes.
Yeah. So good evening, everyone, and thank you so much, Aakanksha, for the wonderful introduction and starting off the session in a positive note. And thank you so much, Palka, for inviting me to address today's esteemed gathering of audience on the importance of asset allocation in today's market scenario. So the way we have done it is that we will cover essential concepts associated with asset allocation, and then we will open the floor for Q&A. About myself, Aakanksha has given a beautiful introduction. Yes, my name is Amrita, and I head the Learning and Development Department for Sundaram AMC, and I've always feel honored to partner with Mastertrust in knowledge sharing sessions. Now, let's quickly delve into what is Essence of Asset Allocation. And before that, the chat box is opened to everyone. We'll make it an interactive session. So I would request your active participation because the entire program is interspersed with lots of knowledge checks. So let me start with an analogy, and the analogy is that of FIFA World Cup. Now, whenever the years when the World Cup event has been held, we have had different winners, right? For example, for Qatar 2022, where the World Cup was held, the winner was Argentina, and they had a different style of play, which is, they have a good team of athletic players, great at dribbling, great at formations, etc. And 4 years prior to that, the event was held in Russia, where the winner was France. And France is known for their creative flair. And then 4 years prior to that, the event was held in Brazil, where the winner was Germany. And Germany is known for their superb counterattacks. And again, 4 years prior to that, the event was held in South Africa, where the Spaniards won the FIFA World Cup. So what I'm essentially trying to say is that just like a major sporting event where winners rotate, different teams with different skill sets, with different flair are pegged against the best of the best players, and then they, kind of win the most coveted trophy. Similarly, every asset class has different risk return characteristics, have different specific purpose, specific objectives, and no asset class will perennially continue to occupy the numero uno position. And the fact is that every asset class has different way of reacting to a particular situation, circumstance, etc. Therefore, their returns are derived basis the situation and the circumstances and their characteristics and their specific objective. So that's the reason why asset allocation is so important. So let me share a particular table with you, which is spanning across 20 years. And the way to read this table is that for every year, the asset class, which is say equity, there are numerous asset classes, equity, debt, real estate, etc. And we've also considered consumer price inflation to be a hypothetical asset class, which obviously stands for inflation. If you have to read this table, the way the table goes is that every year, the one at the top is the top performing investment avenue, and the one at the bottom is obviously the bottom performing investment avenue. And we can see that the years of turmoil, be it 2009, which was the year of a global financial crisis, equity actually delivered negative returns. And gold, which is considered to be a hedge against a lot of macroeconomic uncertainties, was one of the best performing asset class. Similarly, if we have to fast forward to 2020, again, equity may not have had a great run thanks to COVID pandemic, but gold emerged victorious. Now, if you look at the last 4-5 years, equity has been doing very well. And when I speak about equity, we are speaking about Indian equities, which has done phenomenally well for the last 3-4 years. So the point is that we don't see one asset class always having a monopoly. It is basically some years and some economic conditions shrouding that particular financial markets that needs a particular investment avenue to do well. Therefore, there is an essence and there is a significance of asset allocation. So in this program, we will delve into the concept of asset allocation. We will look at why asset allocation is so important. When we speak about asset allocation, we might encounter a slightly technical concept, but doesn't matter because behind that technical concept, there are these data, fact, analysis, and studies that has been done to drive the point that asset allocation is something where for a given level of risk, you can accentuate your returns, or for a particular level of return, you can actually cut down the risk. And that's called efficient frontier. So we will delve into what is efficient frontier. We will look at what is this basic terminology and how does it fare across a 2-asset, 3-asset portfolio, etc. Is asset allocation a step, a process? How do we do it? And there are different types of asset allocation strategies, be it strategic, tactical, dynamic asset allocation. And then we will look at this concept called rebalancing. Now, I'm introducing a lot of heavy words and heavy technical terminologies here. And sometimes for an investor to do all of that on his own or on its own can be a little daunting. It could be a tedious task. So can we look at hybrid funds? What are the type of hybrid funds available? The plethora of hybrid funds available. What are they, first of all? What's the underlying rationale behind hybrid funds, etc.? And if time permits, maybe I'll touch base upon Sundaram multi-asset allocation fund. But let's enjoy and understand what the concept of asset allocation is. So what is asset allocation? Just like a garden thrives with different types of plants, with diverse plants. Similarly, an investor's portfolio also should comprise of varied investment avenues. So asset allocation is a process. Right? It is a process. It is a technique of allocating your money that you're looking at investing into different types of investment avenues, which are called asset classes like equity, debt, real estate, cash, so on and so forth. Now, why asset allocation is important is that because every asset class will have a certain return tendency as much as a risk tendency. And not all asset classes are Siamese twins. They are not a gymnast in a gymnastic competition, and their movements may not be synchronized, which means that in a particular situation, gold might do very well, but equity might be a flop, and vice versa. Equity might do very well, and that may not be the year for gold. So therefore, every asset class has its own way of reacting to different years, different markets, different situations. Therefore, asset allocation helps in balancing that risk. So it's a great way to contain your risk, and if not get exorbitant, exhilarating returns, but get a return which beats inflation, which helps you in your wealth creation. So in simple language, it is about devising your money, allocating your money into different asset classes. The primary reason is you want to balance risk and reward. Now, why asset allocation is important? Because there has been a lot of studies concerning asset allocation. So gentlemen like Brinson Hood, Brinson Singer, Bivawa in the 1990s, 2000s, for 20 years, they have studied a lot of portfolios to come to the point that it's not that we should be entering equity market at the most opportune time, or we should be selecting the right stocks, but what contributes risk reduction. I'm not speaking about getting extraordinary returns. That may or may not be in our hands. But if something is within your control, and the control is, can I, my portfolio, and the value at which it grows, or at the value at which it sometimes degrows, can that fluctuation be contained? And asset allocation is one such technique which helps to minimize risk. It's one of the single most contributor beyond security selection, the stocks that you pick up, beyond the right opportune time to enter into market, beyond other factors. The biggest contributor for risk reduction is asset allocation. Now, and studies are there to prove it. Now, why should we be looking at asset allocation? So before me actually telling you why should we be looking at asset allocation, I would like to hear from all of you all. And the chat box has been opened for that specific purpose. That why do you think as an investor, we should be allocating our money into different asset classes? Is the reason, that just like, the soccer teams and different countries do not win the World Cup every year, every 4 years. Similarly, asset classes do not occupy the number one position, which I've mentioned earlier, every year. So is it because winners rotate? No asset class continues to outperform and get ranked number one? Or is it that asset classes have a particular objective and purpose? Or is it that each asset class has their advantages and disadvantage? Why do you think there is a requirement for an investor to spread out his investments into multiple asset classes? What would be the reason? You can use the chat box and give your answer. It's a very simple trivia, simple question, and your interactivity is something that matters a lot to us. Aakanksha, I hope the chat box has been opened.
I am just quickly checking, Amrita. Most likely
Sure.
it is open.
Sure. So Mr. Chandar says yes to manage the risk diversification, to diversify the risk. Absolutely right. Thank you so much for the wonderful, Mr. Sunil Kadam is of the opinion that yes, to diversify the risk. Absolutely right. So I think every reason is important. Number one is that I don't know which asset class is going to be number one for this year, or I might know, but markets are so dynamic. There are multitude of factors that impacts equity markets, capital markets. So it's very difficult to gauge which asset class is going to be the number one performer this year, because every day there is some event or the other that take place which has an influence on capital markets. So winners do rotate. Every asset class has their purpose, has their objective, have their advantages and disadvantages. I think the reasons are very important. And the third reason that has come in is that I want to diversify. I want to reduce my risk. Absolutely right. So the reason why we need asset allocation is that we can't have those biases. We need to have a judicious combination of different investment avenues. Every asset class has its own objective, its own advantages, disadvantages. And the last point is that asset classes may not be correlated to each other. So there is a new terminology being introduced, which is correlation, and we'll delve into it, what exactly it is. But let's look at the purpose and objective and have a quick overview of that. So if you look at the equity family, which comprises of large caps, small caps, mid caps, well, equity is there for wealth creation, for capital appreciation, to give you that growth, to beat inflation. But if I'm going to have a 6 months time frame into equity, equity becomes a twin-edged sword for me. It only works well when my investment horizon is on the longer side. It gives me that returns, but it entails volatility. If I'm going to look at debt as a category which comprises of government securities, bonds, debentures, debt funds, etc., there is a steady income. I might get my principal back if I'm investing into a singular bond, or if I'm investing into a debt fund, I may not get that 15-16% return, maybe a return in the range of 8 to 10%, or maybe 7 to 8%, but it may not beat inflation as such. If we are looking at real estate, well, again, there is capital appreciation, regular income, but there could be liquidity issues. Real estate performances, especially when it comes to property, can be patchy in a lot of places. When we are considering private equity, well, the potential of returns is higher, but also the risk is higher. Not every private equity, which means unlisted companies, companies that are not listed on the exchange, not every company which is in the private equity mode will continue, will be a Airtel or will be a Zomato. As much as there are success stories, there can be sob stories as well. So the risk is definitely higher. You need patience. You need to have a long-term time frame. So on and so forth. If we consider gold, say, for example, is a wonderful hedge against any kind of turbulence, turmoil, uncertainty in the world. But not many people realize that gold prices can also be volatile. So, and gold has a cyclical performance. It does well, it emerges well when there is a lot of ambiguity in the world. International equities, we get into US markets, various other markets and invest into their products. It's fantastic, but there could be currency risk, there could be geopolitical risk. So the reason is that there are opportunities and there are certain things that we need to be cautious about. So therefore, let's look at this concept of correlation. Now, correlation in simple languages, let's imagine there are two dancers in a room. Now, if one dancer, jumps up, the other dancer also jumps up. Now, that's positive correlation, which means that if one dancer is spinning taking a spin from the right, the other dancer also takes a spin from the right. Now, which means that their performance, their dance is quite synchronized, which means that in a given situation, both of them are dancing in the same fashion, in the same format. And that is called positive correlation, a correlation of one, which means in a given situation, if one asset goes up, is the other asset going up or not? Now, what is negative correlation? Negative correlation means that, again, taking the same analogy of two dancers, when one jumps up, the other jumps down. When one spins on the right-hand side, the other spins on the left-hand side, which means that their performance is is not synchronized. It is unsynchronized. That means that in a given situation, if one asset is doing great, the other asset does bad. And that's a negative correlation. And what is zero correlation is that there are two dancers, they are not bothered about each other. They're not bothered whether there is synchronicity in their performance or not. It could be that when one is jumping up, the other could jump up or jump down. They're not bothered about each other. And that is zero correlation. So in simple language, correlation is in a given situation, whether two securities, two asset classes, two investment products, do they move synchronized manner up or down? Or do they have some sort of a harmony breakage, some sort of a disorganized synchronicity? And that is what is correlation. And you'll be surprised to know that the correlation between equity, Indian equity and Indian debt is negative, which means that it is slightly negative, which means that when equity is not performing well, debt, may not perform as badly as equity, but might give some returns. Similarly, equity and gold have a negative correlation. When gold is in the doldrums, equity does well, and vice versa. Similarly, debt and gold has negative correlation. So the point is that if I'm having one asset class whose movement is something like this, and I've allocated out of my 100 rupees, 50 rupees into this asset class, which has a movement like this. And I'm allocating the other 50 rupees into another asset class whose movement is exactly opposite. What happens is that the risk gets minimized, if not totally annihilated and mitigated. And what I get is a reasonable investing experience. So we don't want to have high palpitations and nervous breakdown and insomnia and sleepless nights to see a portfolio in the red, because not many people have that ability to fathom the volatility that comes with equity. But if you have a portfolio where overall it's been growing, the degree of negativity has been contained, a lot of people may be able to swallow that. That is the reason why we have something called loss aversion bias, which means not many people are willing to see reds in their portfolio, negativity in their portfolio. But if their portfolio, if their investment is allocated into different products, it helps to minimize that. Now, I'm again showing different data points. Just to explain the same correlation aspect is that, say in 2020, equity did not have a great run. But if your product was allocated into debt and gold, obviously they were good cushion against the equity part not doing well. Now, for the last 3-4 years, it has been equity that has been doing well. And if your money has been allocated, now, if we look at the kind of returns, like the last 24 years returns from equity, it has given a 14% return, which is, if you apply the rule of 72, money has doubled every 5-6 years. Compare that to debt, which is a 7.4% return. 7.4% CAGR, and if your inflation is at 6.5%, it's not beating inflation much. You've saved, you've created wealth, but that wealth is not giving you the purchasing power. If you're looking at gold, gold has given a 10% return. Which is good. But if you have a portfolio which has a bit of debt, a bit of gold, a bit of equity, this kind of a combination of 50 equity, 30 debt, and 20 gold, there is this 11.3% CAGR, which is good enough to beat inflation. But then you will not be going through too much of gyrations, too much of fluctuations. You would actually have a peaceful night, a peaceful sleep, and therefore a reasonable investing experience. So that is what is efficient frontier all about. Seems to be the jargonized words like modern portfolio theory and efficient frontier. They were all ideas and concepts formulated by a gentleman called Harry Markowitz, but it is simple. Both of these terminologies mean that allocate your money into multiple investment vehicles so that you get multiple income streams. And the fact is that your whole idea is that, can you contain the risk and have a reasonable return? Or within, can you have a combination where the return remains same, for a given level of risk, you can accentuate return. Either contain risk for the same level of return or accentuate return for same level of risk. You might think, Amrita, what are you saying? I need some more explanation to it. So doesn't matter. Let me explain what is efficient frontier. In the parlance of wealth management, a portfolio which is 100% into debt is considered to be an inferior portfolio. Because by the way, you have 100% debt allocation, which is giving you 7% return, and it comes with 5% volatility. Now, what do you mean by volatility? Volatility is like a pendulum, and volatility is depicted by standard deviation. Standard deviation means degree of fluctuation. So what is a pendulum? A pendulum can go to the right, then come to the center, go to the left, then come to the center. And if we see a horror movie, the pendulum will be grotesquely gyrating, right? It will be violently gyrating. So higher the volatility number, higher is the fluctuation, higher is the gyration, higher is the volatility. Now, when we are looking at debt, it gives you, debt means investment avenues like bonds, debentures, corporate bonds, G-Secs, treasury bills, etc. Now, if you have a portfolio of different types of debt securities, it's giving you a 7% return, but it's coming with a lesser volatility. But this return is not beating inflation. If you're 100% into equity, it gives you 18% return, which is phenomenal for a duration, for a tenure of 20, 21 years or more than 20 years. It's giving you 18% return, but it comes with 18% volatility, which means the gyrations, the fluctuations are there, right? But over a period of time, the fluctuation gets contained. Now, if the risk appetite of an investor is conservative, and you tell that investor, let's do one thing, predominant amount, let it get invested into debt asset class, but you should take some 20-25% exposure to equity. Now, what happens is that the returns gets accentuated to 10%. The volatility is within an acceptable range. Now, why do I say it is acceptable range is that if you want to find the range of returns possible by a particular investment strategy or investment option, All you have to do, this is getting a little bit technical and mathematical, is basically by adding return plus volatility or subtracting return minus volatility. So 70% of the time, if my luck is great, I might get a return which is 10 plus 8, which is somewhere around 18%. If my luck is bad, really bad, I might get a return which is 10 minus 8, which is somewhere around 2%, with the median or the average return being 10%. So my range is 2 to 18, the center point being a 10% return, 2% return to 18% return, and center being 10% return. Now, what is the range of return when I'm into 100% debt? It's the same thing, 7 plus 5, it's 12%, 7 minus 5, which is somewhere around 2%. That means my worst return is 2%, my best is going to be, somewhere around 12%, and my median number is going to be 7.2. So what am I trying to say is that you've done nothing. From 100% debt, you have reduced debt to 75% and added a bit of equity. Your worst return is going to be 2 or 2.5. The best has become higher and the average has become higher. And that is what is efficient frontier. I'm reducing my risk or getting my risk to the acceptable level, and even having a better return. And that is what is efficient frontier. Efficient frontier is I keep my fluctuations in acceptable range and slightly earn higher rate of return. Even 100% equity comes with its own fluctuations and volatility parameters. But if I'm going to reduce my 100% equity to 80% equity and sprinkle a bit of debt to it, I'm still getting a respectable return of 16%. My money still doubles every 6 years, and my risk has come down. So this may not be a 80-20 equity debt, may not be a super efficient frontier or super efficient portfolio, but it is a good enough, semi-efficient, good enough, efficient portfolio. Now, let's look at adding a bit of gold into it. Now, what you have done is that you have sprinkled a bit of gold. And how much gold you have sprinkled is that instead of having 75% debt, now you've pruned it down to 55% debt, 25% equity, you've added 20% gold to it. So debt has come down from 75 to 55, you've added some 20% gold to it. Now, what has been the outcome? The returns have again got increased and the volatility is again in an acceptable range. Now, if you were again an aggressive investor, instead of having 100% equity, which came with 18% return and 18% volatility, if you had just reduced equity a bit, kept equity at decent 80%, added a 20% gold to it and rest all into the zero debt to it, just by adding 20% gold to it, again, we see that your volatility has come down without compromising returns. And that is what is efficient frontier. And that is where it is important that, your portfolio, and I'm not talking about physical gold, it could be gold funds, gold ETFs, but then your portfolio should have allocation to equity, debt, gold, cash, a bit of REIT funds, etc. And when we are comprising and constructing such portfolio, we are creating efficient portfolios or efficient frontier. So what is the process? The next question is, you might ask, Aakanksha, Amrita, and Palka, how do I do asset allocation? Now, the step is that it starts with you as an investor. What are your financial goals? Is it, your child's education, your retirement, buying a house, etc.? What is your risk appetite? And risk appetite is further broken down into risk tolerance and risk capacity. What is risk capacity? I'm a youngster. I have many years to work. I have good health. That is a risk capacity. Having a steady job, a steady income, good enough savings is risk capacity. You have the capacity to take risk, which means invest into a high return, high risk asset class like equity, private equity, so on and so forth. Risk tolerance is that I might be very wealthy, I might be young, but my psychological makeup is that I get perturbed by slightest volatility, slightest negativity in my portfolio, which means risk tolerance has a lot to do with your psychological mental makeup and the kind of knowledge you have. And that's where Master Trust will help you to understand what is your risk appetite. Is it conservative, moderate, aggressive? What is the time frame you're investing into? For 1 year, for 5 years, for 10 years, for 15 years, so on and so forth. And this framework, what's your goal? What is it that you want to achieve? What are you planning to save your money for? What's your risk appetite? And what's your investment tenure? So for example, somebody who has a aggressive risk appetite could afford to have a higher exposure to equity. Somebody, an investor who has a conservative risk appetite, would actually have a tapered down exposure to equity and more towards debt. So this is the asset allocation process. And that is where, once this has been done, what's your goal? What's your risk appetite? What's your time frame? Then all that permutation combination happens, that X percentage, what percentage should get into different asset classes. Now, we have discussed a lot of concepts. We have discussed what is asset allocation. We have discussed efficient frontier. We have discussed reasons for asset allocation. Now, how do we asset allocate? You might still ask. So your goal, time frame, and risk appetite, that framework is actually called strategic asset allocation. I've given you a lot of information here. So which means that as per my goal, I should be, and for my time frame, assume it's 10 years. And maybe if I'm a conservative person, slightly conservative person, not heavily conservative investor, maybe my asset allocation is 45% equity, 45% debt, 10% liquid. Now that's called strategic asset allocation. Now what's tactical? Tactical is moving into market at the right time. We feel that markets are bullish, we will have more allocation towards equity. We feel that markets are bearish, we'll get out of equity and put it into debt. That's tactical. So tactical is moving your money into a product as per market conditions. Or it could be that your base is that, I'm going to keep 45 equity, 45 debt, 10% liquid, but I'll have a range. My equity can come down by 30 to 35%, can go up by 55%, plus minus 10. That means strategic can be your fulcrum and a little bit of range here and there to capitalize on market conditions and enhance equity or enhance debt or enhance other asset class exposure. That is called tactical. Tactical is capitalizing on market movements. And then a lot of fund houses, asset management companies are coming out with dynamic asset allocation products, which
Amrita,
is that, yeah.
I'm so sorry, but before we enter into this discussion of strategic, tactical, and dynamic, since you
Sure.
showed in your last slide that
Yeah.
your major asset classes are your equity, debt, and liquid, because
Right.
I'm sure most of the audience have heard hybrid as a category. So,
Sure.
do we count hybrid as a separate asset class, or do we count it within equity and debt?
So hybrid is a product. It's a wonderful question, Aakanksha. Hybrid is a product. It is not an asset class as such, because hybrid is an avenue that gives exposure to different asset classes, right? So
Right.
it could be a category within MF. So in mutual funds, we could have equity fund category, debt category, right? Solution-oriented category and hybrid category. It's a category amongst MF, but it's not an asset class as such. I hope I'm making it clear.
Yes, yes. And also, team, please pour in your questions so that we can take it up towards the end of the session. Thank you.
Great. Thank you so
Amrita,
much,
please continue.
Aakanksha. Thank you. Sure. So what is dynamic asset allocation is that you use certain mathematical models. It could be that you're looking at a P ratio, which is price to earnings ratio. A price to earnings ratio is for every 1 rupee earning, what is the price you're willing to pay to acquire the share of that company? Or you might look at price to book value ratio, or something like a B ratio, which is what's the, these are different types of what's the GSEC yield versus earnings yield. There are different parameters and formulas and algorithms built, and the system and the process and that formula determines where should be equity, debt, and different asset allocation to be done. So there are these different models. And when we speak about allocating money into different asset classes, we are not just allocating money. Sometimes we have to pull out money and put it in something else as well. So then the concept comes of rebalancing. So what's rebalancing? Is that assume that in a simplistic format, I have allocated 70% into equity and 30% into fixed income. And there has been a superb equity market performance. Now, my value in equity has grown up and has expanded a lot more. And my equity, now my allocation stands at 80% equity and 20% debt. Now, it is quite different than what I had signed into, what I had agreed into. So what am I going to do is take off 10% from this 80 and put it into fixed income to reinstate the allocation back to 70-30 equity fixed income. Or if I have surplus money, I'm not going to allocate into equity, I'm going to allocate into fixed income. The idea is that there is a beautiful equity market performance. Now my original asset allocation has got skewed. I am reskewing it back. I'm reinstating it back by either selling off something and buying something, or ignoring the one that has performed and taking care of the asset class which has not performed by pouring in a lot of money. So what's happening? It's huge. It's basic human tendency that when something is doing well, we want to pour in a lot more money. We want to invest into a lot of money. Here you're taking a contrarian approach, and you're taking a contrarian approach by leaving aside all your emotions, all your the impulsive tendencies, all your biases. So it's a very scientific process to rebalance. That means what am I trying to do is that book those profits from equity without my emotions getting mingled, and deploy that money back to a low risk, low return asset class to contain that risk, to avoid over exposure to one asset class. Now, all that is fine. We learned about tactical, we learned about strategic, we learned about a formula that determines where the different asset allocation has to be done. But my question to you is, do you think it is that easy? Forget about rebalancing, even to decide which asset class our exposure should go into, to what percentage it should go into. Do you think it is a very easy and a seamless method? How many of you think it is rebalancing or even doing a strategic asset allocation? This is my goals, my risk appetite, my investment tenure. I'm going to have exposure to multiple investment avenues. And then I'm going to do a rebalancing that every time equity value is up by 10%, I'll book profits and put it into something else. Is it an easy, seamless method to execute? How many of you think yes? If it is yes, please use the chat box and place a yes. How many of you think it is no? Then use the chat box and let me know if it is no. So Anil says, Mr. Anil Garg says it is no. I'm keen to hear from everyone कि आप लोगों को कितने लोगों को लगता है कि ये नो है. तो सौम्यदीप जी कहते हैं नो है, प्रमोद जी कहते हैं नो है, सुनील जी कहते हैं कि यस है. तो देखिए, सो द थिंग इज कि नो यस यस, आई एम ग्लैड कि बहुत लोगों को लग रहा है कि ये यस है, बट लेट मी से कि ये मोस्टली नो है. एंड इट डिपेंड्स कि आपके पास कितना एक्सपर्टीज है, आपके पास वो इंफ्रास्ट्रक्चर है, वो सॉफ्टवेयर है, आपने क्या कोई एकदम फुल प्रूफ मैथमेटिकल मॉडल, सॉफ्टवेयर, आर्टिफिशियल इंटेलिजेंस, डेटा साइंस ड्रिवन प्लेटफॉर्म में इन्वेस्ट किया है, जो आपको बहुत अच्छी इनपुट्स दे रही है कि कौन से एसेट क्लास में एक्सपोजर होना चाहिए, कब हमें रीबैलेंसिंग होना चाहिए. अगर आपके पास है तो आप यस कह सकते हैं. Otherwise, if you don't have it, then the answer is mostly no. So if you have those infrastructure, the knowledge capital, the knowledge framework, then go ahead. Yes, it is easy. Otherwise, no. In my opinion, it is not that easy. Shifting money, first of all, forget about shifting money कि कहाँ पे invest करना है, कि कौन से asset class में invest करना है, फिर एक asset class से कितना profit book करना है, कौन से asset class में invest करना है, वो उतना seamless process नहीं है, क्योंकि number one behavioral biases आ जाएंगे. अगर इक्विटी में गति बहुत अच्छी है, परफॉर्मेंस काफी अच्छा है, तो आपको लगेगा अरे सब लोग इन्वेस्ट कर रहे हैं, न्यूज़पेपर में बहुत अच्छी पॉजिटिव न्यूज आ रही है, तो देयर इज अ हर्ड मेंटालिटी, देयर इज एन ओवर कॉन्फिडेंस बायस, देयर इज एन ऑप्टिमिज्म बायस. इफ मार्केट्स हैव स्टार्टेड टैंकिंग, दैट मींस देयर इज अ कहावत कि बाय लो सेल हाई. Whenever equity markets correct, the P ratios come down. Maybe the company is having good earning potential, but now it's available at a good price. And you might be thinking, no, there's so much of correction, there might be more correction. So there is an availability bias, a loss aversion bias coming in. Behavioral biases come, but take over. Sometimes there is a momentum in market and you have profit booked from equity beforehand. So wo bhi ho sakta hai. सिमिलरली टैक्सेस, अगर आप ऑफलाइन ये सारी चीज करेंगे तो बेसिकली द टैक्स नाउ इज दैट 12.5% का टैक्स लगेगा, तो आपको टैक्स भी पे करना होगा, तो टैक्सेस का भी इम्पैक्ट आ जाएगा, एग्जिट लोड्स का भी इम्पैक्ट आ जाएगा अगर उन फंड्स में एग्जिट लोड्स रहते हैं। और जब बहुत ज्यादा शार्प करेक्शन होता है, इट अफेक्ट साइकी मोर than anything else. Then we get so perturbed, that recency bias, that availability bias, recent dramatic things affect psychology so much कि हमें लगता है कि नहीं, हमें rebalancing अभी करना नहीं चाहिए. Again, behavioral bias takes over. अभी कितना हमें प्रॉफिट बुक करना है, टू व्हाट एक्सटेंट वी हैव टू गेट आउट ऑफ एन एसेट क्लास, वेदर 2% प्रॉफिट बुक करना है, 10% करना है, 5% करना है, वी डोंट नो. So what is that trigger point for rebalancing? And what frequency we have to do it? Do we have to do it daily? Do we have to do it monthly? Do we have to do it So it is, if you have all your statistical models and data science driven systems, then go ahead. Otherwise, if you do not have it, then I would say manual rebalancing, asset allocation बहुत बड़ा investor के लिए challenge है. तो इसके लिए I would suggest कि आप hybrid funds देखिए. And what is hybrid funds? It's like a one-stop shop solution for asset allocation. And there are 8 categories available. So the reason is that mutual fund has been given as a pass-through status. इसका मतलब है कि whenever fund manager is profit booking from equity and getting into debt or vice versa, within the fund, when he's booking profits, they don't have to pay tax. But as an investor, अगर आप किसी fund से redeem कर रहे हैं, आपको tax pay करना पड़ेगा. तो यहाँ पे प्रोफेशनल मैनेजमेंट भी है, डाइवर्सिफिकेशन अक्रॉस डिफरेंट एसेट क्लासेस भी मिल रहा है, देयर इज सम साइंटिफिक मॉडल, देयर इज सम ब्रेनस्टॉर्मिंग, डिस्कशन, पोर्टफोलियो मैनेजमेंट टीम, एक्सपर्ट्स हु आर मैनेजिंग इट. तो ऑब्वियसली रिस्क को कंटेन, एक फ्लेक्सिबिलिटी दी जाती है कि इनको पता है, देयर आर एक्सपर्ट्स, दे आर बीइंग पेड फॉर इट, कि व्हाट इज द टाइम टू टेक व्हाट एक्सपोजर टू व्हाट रेंज एक्सेट्रा. कन्वीनियंस है, आपको ये डिसाइड करने की जरूरत नहीं है कि व्हाट परसेंटेज शुड बी इनटू डिफरेंट एसेट क्लास. द फंड इज डिसाइडिंग ऑन दैट ओन. एंड देयर इज समथिंग कॉल्ड सिस्टमैटिक विथड्रॉल प्लान, which means that आपने hybrid fund में you have invested for 5 years, 7 years, you can actually do a systematic withdrawal plan. Regular आप एक income भी बना सकते हो. And all these hybrid funds are funds that have given reasonable experience, investing experience, respectable wealth creation also. So there is capital appreciation. So there are 8 categories to choose from. So there is aggressive hybrid. किसी का risk appetite aggressive है, as an investor, you have an aggressive hybrid fund which will invest minimum 65 to 80% into equities, rest all into. So this is a 2 asset portfolio, equity and debt. Conservative hybrid is that a client, who does not want to take excessive exposure to equity. There is this product called conservative hybrid, where 80% will be debt and minuscule percentage equity में जाएगा. Balanced hybrid fund, वो उन इन्वेस्टर्स के लिए है जो 40 to 60% मतलब इक्वल एक सोल्यूशनिंग चाहते हैं इक्विटी डेट के प्रति. मल्टी एसेट एलोकेशन, इसकी वो इक्विटी और डेट से परे भी सोचता है, विच मीन्स दैट वो ना केवल इक्विटी में इन्वेस्ट कर रहा है, ना केवल डेट में इन्वेस्ट कर रहा है, वो दिस पर्टिकुलर प्रोडक्ट विल इन्वेस्ट इनटू गोल्ड. सो यूजुअली यू विल हैव 3 एसेट क्लासेस, इक्विटी, डेट, गोल्ड, एक्सेट्रा. आर्बिट्राज का क्या मतलब है? आर्बिट्राज का मतलब है कि यू आर ट्राइंग टू फाइंड कैपिटलाइज ऑन प्राइस डिस्क्रिपेंसी. इसका मतलब क्या है कि मान लीजिए इन्फोसिस स्टॉक, से फॉर एग्जांपल, नॉर्मल स्टॉक मार्केट में, जिसको कैश मार्केट कहा जाता है, इज अवेलेबल एट 1950, पर इसका जो डेरिवेटिव वर्जन है, विच इज फ्यूचर्स, इज अवेलेबल एट 3000 रुपीज. तो आप नॉर्मल स्टॉक मार्केट में इन्फोसिस शेयर को खरीदेंगे और इसके फ्यूचर को सेल करेंगे. तो फ्यूचर में आप बाय कर सकते हो, फ्यूचर एक कॉन्ट्रैक्ट होता है, डेरिवेटिव कॉन्ट्रैक्ट होता है, उसको आप बाय कर सकते हो, सेल कर सकते हो. सो व्हाट इज हैपनिंग इज, आप ट्राई करते हो टू फाइंड आउट इस एसेट क्लास की क्या डिफरेंट मार्केट्स में प्राइस डिस्क्रिपेंसी है कि नहीं. सो आर्बिट्राज फंड को प्योर इक्विटी फंड से अगर आप कंपेयर करेंगे, इसकी रिस्क बहुत कम है, 3 to 5% की रिटर्न्स देती है, वो भी एक कैटेगरी है, विच मीन्स प्लेइंग इन डेरिवेटिव्स. दूसरा है इक्विटी सेविंग्स फंड. तो इक्विटी सेविंग्स फंड में क्या है कि मिनिमम इट टेक्स 30 to 40% प्योर इक्विटी, 20 to 30% डेट, रेस्ट ऑल आर्बिट्राज. ओवरऑल 65% की इक्विटी रखेगी, but it will get into equity debt arbitrage, pure arbitrage like arbitrage funds नहीं होता, लेकिन some arbitrage होता है. And dynamic asset allocation plan, जब हमने देखा dynamic asset allocation fund की strategy, dynamic asset allocation plan में क्या होता है, equity debt and maybe little bit of cash. Equity debt usually एक होता है, they use these models, P ratio, PB ratio, B ratio, VIX, बहुत सारे market indicators, macroeconomic indicators, उसको study करके every month, every 15 days वो डिसाइड करते हैं कि इक्विटी और डेट और हो सकता है कि कुछ और एसेट क्लास हो, उसमें क्या एलोकेशंस होनी चाहिए. सो यू हैव प्री पैकेज प्रोडक्ट्स. द फंड मैनेजर इज डिसाइडिंग कब रीबैलेंसिंग करना है, कब नहीं करना है, एंड इट टेक्स अ लॉट ऑफ टेंशन, अ लॉट ऑफ मैनुअल एफर्ट फ्रॉम योर साइड. एंड इफ यू आर गोइंग टू लुक एट कि इनकी जर्नी क्या हुई है, arbitrage is like the lowest risk, and returns have been in the range of 3 to 5%. उसके बाद आपका conservative hybrid equity savings आ जाता है, which typically gives you, I might be wrong, and the returns can be higher, lower, or even lower, somewhere in the range of 8 to 10%. रिस्क लैडर के ऊपर आता है मल्टी एसेट एलोकेशन फंड, डायनामिक एसेट एलोकेशन फंड. इनमें क्या फर्क है कि ये मिनिमम 3 एसेट्स में इन्वेस्ट करेगा. मल्टी एसेट फंड, दिस विल हैव 2 एसेट क्लासेस. So this risk ladder, balanced hybrid, multi asset allocation, etc. This will have somewhere around 10 to 14% kind of a return, or 10 to 12% kind of a return, and aggressive is 12 to 15. So this is the range you have. So there is a plethora of range available. I hope I'm making myself clear, Aakanksha. If there
Yes,
are any
absolutely.
questions.
Absolutely, Amrita. It's very interesting.
Thank you so much. So can I proceed if it is okay?
Yes, yes.
So again, a quick recap karte hain. What do you think are the benefits of hybrid funds? Honestly speaking, I would have asset allocated my money into different products. But am I doing rebalancing? No. Have I created wealth? Yes, because I've stayed long. One is stay long and don't rebalance. That itself will give you returns. But if you're looking at continuous monitoring and juggling between different asset classes, I think hybrid fund is a great product, and there are 8 categories to be looked at. So a quick, what do you think are the benefits? Is it diversification? Is it risk management? Is it flexibility? Is it convenience? Is it professional management? What are the benefits? So good responses come in from Mr. Arijit Kole, who says that most challenging is low fund for investors. That's why hybrid fund is good. Absolutely. Low volatility maybe. So Rahul says that I would say ki, Rahul's opinion is that risk management is one of the benefits. Absolutely right. You've got experts to take those decisions. The experts ideate, brainstorm, look at multiple parameters, multiple valuation metrics. Absolutely right, Rahul. Mr. Manish Kumar Tiwari का मानना है कि diversification, of course, equity में भी होंगे 40-50 stocks, debt में भी होंगे 20-30 securities, आपको multiple securities, multiple asset class की benefit मिल रही है. So yes, Manish ji, I agree that diversification is also another benefit. What else? So superb, I would say that all of them are benefit. हमें एक ऐसा रास्ता मिलता है जहाँ पे हम एक ऐसे प्रोडक्ट में इन्वेस्ट करें जो एटलीस्ट 2 एसेट क्लासेस में इन्वेस्ट कर रहा है. एक्सपर्ट है तो डाइवर्सिफिकेशन भी है, एक्सपर्ट के कारण रिस्क मैनेजमेंट भी है, एक फ्लेक्सिबल है, आपके पास 8 कैटेगरीज है, कन्वीनियंस है एज लो एज 500 रुपीज, और एक्सपर्टीज अगर जुड़ती है तो प्रोफेशनल मैनेजमेंट और रिस्क मैनेजमेंट गो हैंड इन हैंड. तो ये सारी चीजें जो है बेनिफिशियल है. I agree, flexible. I would say all Neeraj ji कह रहे हैं, नीरज ग्रोवर जी कह रहे हैं. Yes, I agree with you. Sunil Kadam ji कह रहे हैं कि flexibility as per market movement, which gives better returns. Bang on, sir. Absolutely right. So therefore, what's the taxation? Obviously, taxation change हुआ है. So if you're looking at aggressive hybrid funds, which have 65%, minimum 65% equity exposure, so if you're holding it for 1 year, so gains after 1 year is taxed at 12.5%. Gains less than 1 year is taxed at 20%. There is a catch. Up your gains up to 1.25 lakhs is not taxed. Gains beyond 1.25 lakhs is taxed. If you're into conservative hybrid fund, it is considered like a debt fund because debt exposure is more. So it is taxed as per your tax slab. If you're into funds like your balanced hybrid fund या dynamic funds, कुछ ऐसे dynamic funds है जो 65% equity exposure रखते नहीं है, they play between 35 to 65. तो कभी 65 हो सकता है, कभी 35 हो सकता है. तो उसके लिए भी जो tax है, taxation long term capital gain tax है, it is at 12.5%. But holding period should be 2 years. Less than 2 years, it will be considered as short term tax. And उसपे as per tax rate लगेगा. So be very careful, understand, be in touch with master trust to understand what is that product and कितने time frame तक हमें hold करना चाहिए. So if I have to explain this taxation again in a visual format, assume you've invested, this is just for your educational purposes only. If you've invested in an aggressive hybrid fund or a balanced advantage fund, जहाँ पे 65 ऐसा balanced advantage जहाँ पे 65% equity allocation लिया गया है, then if for 3 years, assume the rate of return is 10%, it can be lesser than that also. This is just a depiction. Your 5 lakhs at 10% compounded return grows to 6.65 lakhs. तो आपका gain कितना हुआ? 6.65 minus 5 lakhs, 1.65, 1,65,500 rupees का gain हुआ. Now, gains up to 1,25,000 is not subject to taxation. So what is your net gain? 1.25 lakhs पे तो tax लगेगा नहीं. तो my net gain is 1.65 lakhs minus 1.25 lakhs. 40,500 is my gain. इस पे if I'm going to put 12.5% का tax, my tax is going to be 5,000 rupees के आसपास. So my investment value before tax was 6,65,500. I'm going to take out this tax amount, which I'm supposed to pay at 12.5%, which is 5,062 odd rupees. So my net investment value is 6,60,437, which means that while my pre-tax return was 10%, my post-tax return was 9.72%. आप पूछोगे कि ये before budget का जो taxation था उससे better है कि नहीं? Obviously before budget की taxation जो थी वो 10% पे थी. तो अगर छोटा छोटा अमाउंट है तो मे बी ज्यादा डिफरेंस नहीं होगा. बिगर द अमाउंट then the previous regime ka taxation was giving you slight benefit. But we have to live with it because taxation laws are subject to revision and we should be aware of it. Finally, to end it, what is Sundaram Asset Allocation Fund? इसमें हम 3 asset class देखते हैं. It is a multi-asset allocation fund. Equity भी देखते हैं, gold भी invest करते हैं और debt में भी invest करते हैं. Equity allocation obviously will be 65 to 70%. But it is including arbitrage and getting into derivatives. जो without arbitrage वाला portion है, we are maintaining 58 to 60% equity, predominantly large caps, because large caps in volatile markets are more stable. They are less fluctuating. And we maintain 20 to 25% gold. So which is like इस portfolio को Ray Dalio Holy Grail portfolio भी कहा जाता है. Ray Dalio एक बहुत बड़े investor है, बहुत बड़े author है. उनका कहना है कि अगर आपको multi purpose all weather portfolio चाहिए तो 50 around this kind of a portfolio is good enough. तो 20 to 25 आपकी gold की exposure है and 10 to 15% आप debt में invest करते हैं. So इससे what is it? It was recently launched, but why I'm saying at this market juncture is that there is a little bit of volatility. If you want to participate, I think hybrid fund categories are good. And the point is that look at the efficient frontier. Now, gold also is not all that glitters is not gold, and gold also glitters does not mean it does not come with volatility. Because gold, if you look at last 3 years return, minimum has been minus 8%. It has also given stupendous returns. So gold is not always positive return oriented. It has given you negative returns also, be it on a 3-year data cut or a 5-year data cut. But when you are getting into a multi-asset, what's happening? You're creating something which is efficient. My minimum is not negative. My maximum may not be 30-25. It's in that range of 18 to 2%. But my average is 9.5. So that is the study we have done for a big time frame, for a 13-year time frame, and I thought that I should touch base upon this. So with this, I come to the end of the program. We live in a VUCA world. VUCA ka full form is volatility, uncertainty, complexity, ambiguity. It is there. But when you are getting into asset allocation, my objective was to explain what is asset allocation. And it is scientifically proven that it is one of the highest contributor of risk reduction. So high asset allocation via hybrid funds helps you to transcend from VUCA to VUCA, which is vision, understanding, clarity, agility, which is flexibility to invest across different asset classes. So with this, I come to the end of the program, and I thank Aakanksha and Palka to have given me that opportunity to come and address the August gathering on this session. And I'm happy to take any questions that is there. Thank you so much once again. And over.
Thank you, Amrita. You have very beautifully explained with facts why you should not keep all your eggs in one basket. So I think team, the most important takeaway from today's session is that why we need to have certain assets in our portfolio. क्यों हमें कभी एक biasness नहीं होनी चाहिए because equity is giving phenomenal returns in today's market, तो हम equity में डाल दें. Why asset allocation is important and why you should stick to asset allocation in the toughest of the times. So with that, I open the floor for questions. You can write down your questions and we will read it. We can take it up. If in case you would like to ask the questions personally, you can please let me know. And until the time the questions are pouring in, Amrita, I have a question. Since you have particularly discussed about, like you were talking about the benefits because hybrid में already एक flexibility है. Usme the fund manager is actively doing the portfolio management, but आपको taxation benefit है. Apart from hybrids as a category, in the current market scenario, what else do you think are the best funds?
Right.
Best category of funds? Yeah.
So I think even as per current market scenario, it depends upon your risk appetite, Aakanksha. So if the risk appetite of an investor is conservative, they should predominantly park in in an asset allocation oriented product. It could be a balanced advantage fund or multi-asset allocation fund predominantly. And if they're entering into equity, at this point in time, it's advised that the investment into equity should be mostly via systematic transfer plans. That is, park your money into a liquid fund and then periodically transfer the money into an equity product.
Staggered build-up. That's the situation in the current markets.
Yes.
And जब हम ये particular segment discuss कर रहे थे, do you think, given that एक interest rate reversal is expected and US has already started, is this good time to look into debt mutual funds also? Given that आपकी category में अगर debt आता है तो?
Sure. So, see, US has cut interest rates. Do we expect RBI to follow suit? Most of the opinion is divided into two cohorts. One cohort thinks that RBI will also start cutting rates. The other cohort thinks that India is a unique country. India has its own economic, and inflation opportunities and challenges. So it could be that RBI may not tread the path of cutting rates. Now, since there are two divergent cohorts which are there, so I think at this juncture, taking a tactical call and getting into a corporate bond fund, one can, right? But having said that, debt allocation should be more from a strategic objective. Okay, I need debt in my portfolio. Correct. And if RBI cuts rates, then it's good,
it's an added advantage.
It's an added advantage.
That's thank you, Amrita, for that clarification. Also in your presentation, while you were talking about strategic, tactical, and dynamic asset allocation, can you share few examples on tactical asset allocation? Is investing in thematic funds, जो इस time market का बहुत craze है, like there are themes that people are investing in.
Yes.
So will this qualify in a tactical investment, and what can be other example of tactical investments?
So the example that you gave is great, like playing into a particular theme. It's a thematic, it's a tactical investment. It may not be tactical asset allocation because, within equity, I'm looking at a theme. If I'm looking at equity as such, I'm getting out of from debt in totality and getting into equity, that is a tactical move, tactical asset allocation. But getting into a themes is more of a tactical move, may not be a tactical asset allocation.
Okay. Yeah. All right. Thank you. And in fact, on your rebalancing slide, you had mentioned that rebalancing is very specific from
Hmm.
client to client, investor to investor. But
Hmm.
still, what do you think would be an ideal time for revisiting your portfolio for rebalancing? Is it market related, that when you feel that equities have become very expensive, you need to do some profit booking and move into other asset class? That is the time you should visit your asset allocation, or it should be a monthly or a quarterly affair or a 6 monthly affair?
So I think that's a wonderful question, Akanksha. It should start with a periodic review, as you've mentioned. At least it should start with something like a quarterly affair, right? Quarterly visit your portfolio, review it. And but having said that, keep your eyes and ears open, be a little bit alert. If you see drastic moves, that's the time, while you're conducting a quarterly review. But it could be that within that quarter, after 2 months, there is a sharp swing, which is unwarranted, and then you want to capitalize it and get into rebalancing. So my thing is, start with a quarterly, and whenever there are sharp swings, you can deviate from your quarterly approach and rebalance your portfolio accordingly.
Okay, all right. I hope our audience is also active and they are listening to this conversation. And if you have some questions, please feel free to ask them. Do not, I mean, since the platform is there, Amrita is there on the platform, generally you would put in your questions in the later after the session is done. So please feel free to ask your questions. We have one question by Mr. Anil Garg. He asks that when asset allocator funds are there, why someone needs to study so much asset classes and take a decision, or instead of diversifying with various schemes, why not to give money to asset allocation fund and then relax?
Very good question. I think sir is very convinced about asset allocation fund. So yes, the easiest route is get into asset allocation fund, and you need not break your head reading about it. And it's a lot to do with our intent and our desire to and our hunger to accumulate knowledge. So if you want to understand about how a product works, what are the nuances, you want to empower your knowledge. So there's no end to it. We should study about different asset classes. And it's a personal choice. It's that I have something I give, and if you trust that the product works well, so be it.
Thank you. Thank you, Amrita. And there's one question by Mr. Rahul Kumar that I think this is not a guaranteed product. Looks like he was talking about hybrid. In equity or equity related investments, there's nothing like a guaranteed product. So I hope, Rahul, that is also clear as we move forward. Nidhi had asked a question that if an investor holds a single asset class, such as equities, for a long term, is diversification still necessary?
So as I've said, that if you're holding equity for a very long term, that is time diversification. So diversification itself is portfolio
That's a
diversification and
great term,
time.
time diversification. Yeah.
Yes, so that's time diversification. But having said that, when we studied efficient frontier, it seems that even if that 100% equity comes with its own set of challenges. For example, even if you've invested for 10 years and you're redeeming money at the time of COVID, maybe your portfolio valuation may not be looking that rosy and that beautiful. There would be a dent to it. So we do not know when our redemption requirements might come in. So therefore, just to be on the safer side, if you could add a bit of some other asset class that gives you the flexibility to redeem, and it actually happened with me during COVID, a lot of my investments were stuck into equity. So it was very difficult for me to redeem money out of equity, because equity, even if I invested for 10, 15 years, there was a dent in valuation, and I was hospitalized. My medical insurance policy for some reason was not working. I had to dip into and dig into my debt portfolio to help me out. So having said that, equity for a long term helps helps in time diversification. But as per efficient frontier concept, if you add a little tinge and a bit of exposure to other asset class, you're pruning down the risk without compromising those returns.
That is a great answer, Amrita. And absolutely, I think cushioning the impact of one asset class, there should always be a combination of asset classes to help you cushion the impacts that one asset class might face. So Amrita, I see that, okay, there's another question by Sunil ji. He asks that what is the difference between flexi cap funds and hybrid funds? Which one is better for current scenario?
Great
So,
question, Sunil, Mr. Sunil. FlexiCap fund is an equity fund, and it gives the flexibility to invest across different types of equity stocks.
Sub-asset classes, yeah.
Yeah. So a FlexiCap fund gives you the opportunity to invest into larger companies, mid-sized companies, small-sized companies, which are called large caps, mid caps, small caps. And hybrid funds essentially start with your aggressive, balanced hybrid and conservative hybrid starts with two asset classes only, equity and debt. At this juncture, I think both are important. As I've said, if I were to be a conservative investor, I would have probably 60% or 70% allocated into a hybrid fund and 30% allocated into a flexi cap fund. If I were to be an aggressive investor, I would probably have 80% allocated to flexi cap fund and still have 20% allocated to hybrid funds.
Thank
I
you,
hope
Amrita.
that makes sense, Aakanksha.
Yes, that does. Anybody else would like to ask a question, or else due to the paucity of time, we'll be wrapping up the session? All right, then. In that case, I think, Amrita, we should wrap a session. If in case there would be any questions, I would definitely get in touch with you. Thank you so much for a very interesting and insightful session. Always a pleasure interacting with experts. Thank you, all the attendees. StreetXperts will be back with more such interesting discussions. In case of any questions that remain unanswered, do reach out to us through your respective RMs or through our website, www.mastertrust.co.in. With that, we would like to conclude this webcast. Thank you all for tuning in.
Thank you, Aakanksha.
Thank you.